everybody, and welcome back to the channel. So we've crossed over a new milestone. We're up over $50,800 in my tax-free savings and RRSP, with $14,000 in gains, up 39% all time. And one notable change was in the RRSP, where I've completely sold out of Starbucks and split the proceeds between SCHD and Vici. I think that it's trading at a pretty high price, and really it's just enthusiasm about the new CEO that they have, but the business still has a lot to prove, as in their latest earnings, same-store sale declines worldwide. So Starbucks is not doing well, and it remains to be seen if they can get back on the right track with improving, their wait time issues, where people just are waiting way too long and not ordering through the app as much as they usually are. So I think that the money would be better served being split into SCHD and Vici, which are a bit more predictable. So we'll see how the RSP goes. Very small account. I only have it for really high yielding US stocks. So anytime I want to buy one of those individually, I throw them in here. And then anytime it's a low yield stock, we have them in the TFSA. So in the TFSA, we are at 48,300 and having a pretty great past month, up 10.95%. So let's look into the positions here. So Amazon is up 38%. So finally breaking past the $200 mark. And they have a lot of interesting AI announcements, where they're making their own AI chips to try and compete with NVIDIA. And they also have a lot of plans with AI, having a shopping assistant, a sizing tool for, if you buy different clothes on Amazon in a certain brand and you want to buy another t-shirt, they can recommend the proper sizing, because different clothing brands can have different sizing. And other applications I want to buy, that knife I bought before, and it can just bring that up for you instantly. You don't have to search through your history. So Amazon is just making it easier and easier to rely and use their service and save you a bunch of time, and just getting you the product you need as quickly as possible. So I am definitely very excited with where Amazon is, and I don't think it's trading at a ridiculous price either, so no reason to sell it. In fact, I think the best is yet to come for Amazon, because the real key to this business is AI, AWS web services. The cloud is growing, advertising is growing really fast, very high margin businesses. The high margin businesses of Amazon are growing the fastest, which is what I love to see. With ATD, I bought one more share going up to 28. So their earnings were okay, and we got a nice little dividend raise of, a little over 10%. So 24.4% in the green on this position. And it seems like the 7-Eleven deal is not going to happen. So they were kind of in the low 70s. Now they're kind of digging themselves out. Brookfield doing incredibly well, absolutely destroying this year, and doing very well in the TSX. So I'm up, high 70% in these positions. Dollarama recently had not the greatest earnings, so they went from, the high 140s down to 140. And I think the sell-off is justified because, while they did increase same-store sales and their earnings were generally pretty good, they were, just not that exciting. The market was expecting more. So this sell-off is justified. I'm not going to be adding at the 140 range, but maybe if this drops to 120, I'd be interested in getting some more shares of this. With EQ Bank, they recently had an earnings report, which, also kind of disappointed the market. They still grew very well, pretty solid earnings overall, 4% dividend raise, which is going to give me more dividend income. So always nice to see that with my holdings. Granite REIT also had a little bit of a dividend raise as well. 3% dividend raise, decent earnings. With HIMS, I got up to 78 shares of this, and we're already in the green by 69%. So that's not too bad for a holding I've had for maybe a month and a half. I did have to sell CP Rail to buy this, but it looks like that was a great decision because CP has declined from the price that I sold it at, and HIMS is really taking off. I really think that a company that's going to be selling affordable medication and drugs to people in the States, which is cheaper than going through the classic insurance pharmacy system. I mean, that just sounds like a no-brainer to me. Like, how can this not succeed? And they are showing that with their really fast growth and incredible results. And the management team, they recently hired someone who is a menopause expert. So they're continuing to expand their product offerings. And once they have a customer, with their customization to make sure that the medication works best for you, you're very unlikely to want to move. And they can grow with the customer over time and generate long-term value from existing customers, because as we age, as our bodies change, as we get, different illnesses, you need different medicines, and Hims is ready to help people and, at a lower cost. So ultimately, I think, if you're helping people, you're offering a great product, a great service, there's only one result, and that is going to be a very successful business. And if you make customers happy, you're going to have a fantastic business. So Hims, I'm very long in. I'm very excited to see where this company goes. I think this is a long-term hold. And the reason I was really focusing on this one last month is because I think this has the highest growth potential of pretty much anything in my portfolio outside of Palantir. So with HTA, I got more shares of this. They also recently announced a 7.6% dividend raise, which is amazing because this is paying like an 8% yield. So this one gives you capital appreciation, high dividend yield, dividend growth. You just own a bunch of great tech companies. So love this ETF. I want to build it up a little bit more. H-Yield doing pretty great, just spitting out a lot of income every single month. And then with Palantir, we are up 194%. So I've already basically tripled my money on Palantir, which is insane. So I've had this business for maybe 6-7 months, and people are saying it's very expensive right now, and I can kind of agree with that. I don't know if it's overvalued necessarily. I'm not buying shares at this point. I'm just holding on because I think that their potential total addressable market is just, I mean, I can't even imagine what it is. They can go into any industry, help improve any business function, because, when companies have access to data and they can make sense of that data, they can make the best decision possible to give the best customer service, to save lives if they're in the medical field, and also to efficiently run very complex inventory businesses for retail or logistics. The existing customers of Palantir are also signing bigger deals with Palantir. So that just shows that not only does the product work, but they see so much value with them that they're going to increase spending with Palantir and continue to use their services. So I can kind of think this like an early Microsoft where, they're just in the enterprise, they're helping small businesses, and it's just an operating system that will help you efficiently run your business to the best of your ability, just maxing out your profit margin, your outcomes for your customers. So fantastic company. I really, really am very excited to see where this is going to go in the future. If this does have a drop, I would love to add more because honestly, I built probably half position in the mid-20s range. And with TELUS, I just acquired 2 more shares, just reinvesting my dividends into this company. And I do think that it is going to be poised to kind of recover in the share price. This is by far the worst performing stock in my entire portfolio. But I do think it will turn around because they are showing signs of lowering capital expenditures and increased cash flows. So they should be able to pay off debt, buy back shares, and give more rewards to the shareholder. And with Visa, they're doing pretty well. They're well up into the 300s. So I would consider them basically fairly valued at this point. And they also announced a 13.5% dividend raise, which is exactly why I wanted to buy Visa, because it's a very predictable business growing at a very nice pace, double-digit pace, growing EPS in the mid double digits, 15% or more, and the dividend is just growing at a fantastic pace. If your double-digit dividend raises, you are doubling your dividend, every 4 years, 5 years. So by the time I'd be ready for retirement, I mean, this one could be spitting out so much income at me, and not to mention all the capital appreciation as well. Just this is one of the best businesses in the world. And then with VDY, I went up to 63 total shares. And this one is just solid, just giving me lots of income, owns all the Canadian banks, oil and gas, and the insurance companies as well. And please leave a like and subscribe to the channel if you enjoyed the video. So dividends earned all time, $3,607.52. The annual dividends increased from just under 2,000 to 2,087. The monthly went from 166.6 to 173.98. And the daily average went from $5.48 every single day to $5.72, so getting close to that $6 a day dividend goal. And the days of freedom, which is how I'm tracking how many days of expenses my annual dividend portfolio will cover in a full year, it's gone from 32.7 days to 34.15, so a nice little 2-day increase. And if the portfolio were to work a 40-hour work week for me, it was earning 96 cents in the last update. Now it earns $1 per hour, and that's a permanent raise that I get, and it's going to only increase over time as I reinvest dividends and the companies in my portfolio continue increasing their dividend payments to me. So we are on our way to hitting our next goals in the portfolio, which is the $200 a month in dividends on average and $6 a day in dividends. And year to date, we've earned $1,495.24 in dividends. The previous year was $1,106. So nice little progress over there. We still have all of December. Only Visa's paid me a dividend so far for December, but there are many more yet to come. So we're going to be well over $1,500 for this year, and the projection for next year is well over $2,000. So the strategy is definitely working. And with the market rising, we are seeing capital appreciation along with dividend income, which is kind of a nice combination. And I'm going to continue providing updates on this channel. And just one thing to note is none of this is financial advice. So just because I'm buying a stock doesn't mean it's a good idea for you to do it, because everybody's situation is different. A different investing strategy or a stock does not fit necessarily everyone. So please do your research and make sure you know what you're investing in before you risk your own money on it. All right, have a good day, everyone, and I'll see you guys next time.